Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Now, I need you to pay really close attention for a moment because a lot of people have been sending in reviews, which we love, thank you, but expecting a subscription to Real Investing Journal, the magazine, which we tried many years ago, as a matter of fact, back in 2017, and it didn't work out like we planned, so we don't do it anymore. So we love when you leave the reviews, but we can't send you a magazine because we don't make it. Please remember that all these weekend shows, these archive shows, and they very clearly state their archive shows, are from many years ago. This one from 2017. So ads you hear and mentions made in the show don't necessarily apply anymore. But thanks for listening, and here's the show.
This program is sponsored by the investment advisory firm Vestry, which is solely responsible for its content. Opinions and advice do not necessarily reflect those of station staff, management, or ownership. Content is believed to be accurate but not guaranteed. Nothing discussed here should be considered personalized investment advice, nor a solicitation or offer to buy or sell services, products, or securities. It is general money knowledge, information, and opinions. You should always seek out qualified tax, legal, or investment professionals for specific advice and guidance.
Reality radio for a really great future. We're talking real money.
I saw something in the New York Times today that shocked me. Over the last 3 years, all of the mutual fund industry in America, except for one fund, all of the mutual funds in America, except for one fund, took in $97 billion.
Except for one fund family.
Except for one fund family.
All right.
And
well,
now
so
that
let's
is
first explain.
That's an insignificant. No,
Yeah.
I mean, it's not. Who everybody's going. So $97 billion. Woo!
Sounds like a lot of money.
What does that mean? Sounds like a lot of money.
Well, first tell us I think you should tell people what a mutual fund is.
It's a portfolio of securities of some kind, be it a portfolio of stocks or a portfolio of bonds or a portfolio of stocks and bonds or a portfolio of gold or a portfolio of commodities or whatever it might
so
be.
So it's a security that holds many securities.
It holds lots of securities in it.
Yeah.
So $97 billion went into the industry with the exception of one mutual fund family, and that mutual fund family is Vanguard.
How much did they take in?
This is the part that just blew me over. I almost fell out of my chair with my latte this morning. They took in $823 billion.
Wait a minute. Everybody else took in less than a tenth of what they took in?
Vanguard in 3 years took in 8.5 times the money that went into the rest of the industry.
I want to mention, too, we tell you to use Vanguard all the time. We don't get anything for that. I think we're going to have to start calling them and ask for a little piece of the
I've asked. I've been asking. I've been recommending Vanguard for almost 30 years, and you know what? They refuse to share.
Right.
They just won't share with us.
Greedy
I
bums.
guess their fees aren't high enough or something. Who knows? 877-397-5666. That's our number. Give us a call.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
And Tom was talking real money at one of our classes today that he did at an event called Retirement Roundtable. Had a great turnout. Got to talk to a lot of people. That's one of the things that we're all about, is just continuing to educate anybody anywhere we can. We speak at AAII meetings. We hold our own classes. We've got the show. And we want to help you individually here on the program. And it doesn't cost anything. And you get actually decent advice, I think.
And I'll add one thing. If you have a group, I'll come and talk to you.
How many in the group? Is there a limit? Is there a number? If I have a group of 3, you're going to come talk to me in my living room?
Yeah, I will, but it won't be what you want me to talk about.
I brought the family over.
I'll give you the finer points on the laws of soccer.
So,
for
Tom,
3
what do you
hours.
want to share with us today? Hey, I got you a gig. You know, you heard about all that stuff with United Airlines, right?
Yeah.
And you're a soccer ref, right?
Mm-hmm. That's true. You did get me. I forgot that. Yeah.
Well, it was somebody threw out the idea, and I think this is a good one. I really think you should run with this. Somebody threw out the idea that if customers on the plane are getting a little belligerent, a little grumpy, before you toss them out on their ear, you have the aircraft referee come running down the aisle with a whistle going, yellow card. Give me a yellow card.
You do
now
not
explain to people
want me,
who don't.
You do not want me blowing my Fox 40 inside a plane because your ears will bleed.
Get their attention.
Oh my God! Oh, it's loud.
2,
well,
what is a yellow card? Tell people, because you know some
caution.
people don't
it's
know.
It's like yellow, like caution. Like, you've done something.
What does that tell you? If you do it
slow
again,
down,
I'm
get
kicking you out.
Well, them's the laws of the game. You get 2 yellows and you're gone. So yeah, I like that. My take on that whole thing, by the way, there will be changes. They will not be allowed to do that anymore.
That's one of those predictions you can always get away with. There will be changes.
Okay, well, no, I'll go one step further.
The market will fluctuate.
I will say the airlines, the laws will be changed. They will not be allowed to remove you.
And the market will fluctuate. Do you hear what Delta did? I love this. I love the confidence of this move.
Yeah.
Delta, the confidence. It's a stroke of brilliance. You know, if you get bumped, the maximum amount of money you can get is $1,350 if you get involuntarily bumped. That's what the law states. Well, Delta says we manage our bumping so well, and they did. They were giving people American Express gift cards for $1,000 when they were bumping them. We're going to give, they just stated this recently, we're going to give anybody we bump $10,000.
Wow.
Please involuntarily bump me. Please.
Let me out. That's good.
I'm going for overbooked flights from now on. We're going to talk a little later about why Vanguard grew as growing as fast as they are growing.
Yeah.
I mean, astonishing numbers, but there's a really good reason for it. But before we do that, Joe, you're up. Welcome to Talking Real Money.
Yeah, hi. I'm 68 years old, and I'm still maintaining a Fidelity Roth IRA. Is this a good thing to do at my age?
How much money's in the Roth? Did you say 68 or 58?
68.
68.
Okay. How much money is in your Roth?
$76,000 there.
$76,000?
Yeah.
Mm-hmm. What's the purpose for the money?
What's the purpose?
Yeah.
Just hanging on to it. Well, I have a house I would need to pay off. I owe about $60,000 on that. So.
Well, let me ask it another way. Is this money you're going to need in retirement?
I haven't touched it. No. I have other retirement incomes that I use right now.
What's it invested in at Fidelity?
Gosh, it's in the old Contra fund and mutual funds. I don't know exactly.
Okay. I mean, I have no issue leaving. Let's start with the broader issue, leaving a Roth alone. If you don't need money, leave it in a Roth, because the wonderful, wonderful thing about Roths is that Roths never cost you any taxes, ever.
Yeah.
And you can leave it to another. If you have heirs, you want to leave money, it's a great legacy method because you hand it off to the next generation, they take it out, and they don't pay tax on it.
Oh, great. Okay.
Now, Now, wait.
Now, getting down to the nitty and the gritty.
I know what's coming next, yeah.
If you're going to stay in Fidelity, great. Just get into Fidelity's index funds as opposed to their older, actively managed funds that have such high expenses.
Okay, index funds.
Yeah,
Okay.
so, and what are they called now? They call them something different. They don't call them the Fidelity.
But they're in their index funds. Just call Fidelity and say, I want a globally diversified index fund.
Yeah, I mean, for $76,000, you buy 4 or 5 or 6 of their funds, all low cost. Come on, what's the name? Come on.
I don't know. I
yeah,
can't
you
remember,
do.
but I'm looking.
Anyway, we're going to give that to you, Joe, before we go, because the Contra Fund has been a very good fund, but it basically is large U.S. companies. It's actively managed. I don't know the expense ratio, Don, but it's not the cheapest, and it's been a family. And my dad loved the Contra Fund because I think the name, he just like Contra.
They just call them index funds now.
No, okay, I thought they had another name. Anyway,
no, Fidelity. In fact, Fidelity has a total market index.
And what does that cost?
It costs. The symbol is FSTVX, and the wow, Morningstar, you're being a little slow for me today.
We're trying to find the expense ratio, Joe. This is how much the fund charges you every year. The money you never see. It simply comes out of your fund every single day. It's one of the great advantages mutual funds have. What is it? FTV. What did I get? FSTVX.
FSTVX.
Yep.
If this is correct, it is 0.05.
0.05?
What I'm looking at.
I mean, that is less than Vanguard.
Yeah.
Woo!
I want to see what's in it. Maybe it's a fund of funds. If it's a fund of funds, then you might have funds that have fees in the fund. But
it no doubt is at that rate. It has to be because
it's not.
Wow. How many? I wonder how many securities. Anyway, I mean that would be
3,300. It's a U.S. only fund. It's a U.S. only fund. 3,300.
So you're getting
stocks.
some small in there, a little tiny bit of value, but it's going to be overweighted, no doubt, to large growth companies. But that would be one place you could put that in a Roth, and you buy and hold that for the rest of your life, which we hope is very long, and you leave it to the next generation, and they get that tax free. It's a pretty good deal.
But if there's $76,000 and I withdrew it, could I expect $76,000 back?
Yeah. Yes.
Okay.
Absolutely. Fidelity isn't one of these companies that has all these tricky fees.
Oh, okay. I was trying to understand your question. No.
On the back end.
No, your money's your money.
It's whatever the value is. Now, bear in mind, whatever the value of the funds is at the close of business on the day you liquidate is the price you will get. For example, if it was $76,000 on Friday and you got out on Monday and the market was down, you might get 75 something. You won't, because the market will fluctuate during the course of the day up or down. But you're going to get right around that, and there's no surrender charge or anything. But again, if my mortgage rate is decent, it's very likely you're going to make a lot more money just leaving it in the Roth and continuing to enjoy some tax advantages from having a mortgage.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
Only because real money is really important to your really great future, the one we want you to have in retirement. And we want to help you not only get there in decent stead, but also have the income you need once you get there and help you solve the problems, avoid being ripped off.
We may have to look at
Catherine,
Fidelity again around. I mean, that is a really inexpensive fund.
It's a really low fee.
Now, I haven't gotten into the nuts and bolts about how much of it is in big companies and small, whether you're getting much value exposure. You said it's all U.S., and that's a lot of stocks actually in the U.S., so you are getting, some pretty small companies. How much of that is the money's committed to those is another point. But wow, that's can I say it? That's dirt cheap, man.
Yeah, and their global ex-U.S. index because you could put these two together.
Yep.
We really, wow.
I know they've been trying to make some moves to get into the indexing game to be a bigger player.
Good for you, Fidelity. Their expenses on their global index fund, 0.19.
Wow.
You put the two of those together, and your average annual expenses are going to be right around
0.1.
0.12.
That's cheap. And you're going to get U.S. and international exposure. What you're not going to get, something we can talk about maybe later, is
some of the other assets.
Well, I mean, if you're, I guess with 70,000, this might be okay, but I might still want to, I personally, I would want to go, I'd rather have exposure to more value and small that has done better over time, and you're not going to get that in those two funds. But this would be a pretty good place for really inexpensive. So
let's see, you put the two funds together, and in aggregate, they have about 5,600 stocks in them.
That's not bad.
That's a lot, but the weighting in both cases, heavily.
Yeah.
Large company growth stocks, both here and overseas. Catherine, you're up next. Welcome to Talking Real Money.
Hi, thank you for taking my call. And I'm pretty sure I know what the answer is based on the fact you have the class about avoiding annuities, but I'm going to ask anyway. So this is called Forethought, F-O-R-E. It's to have money for your long-term care. It's like long-term care insurance. And the way it works is you invest $100,000 in it, and then they add more money. If you're in decent health, you get another $100,000 added. If you're in excellent health, you get $200,000 added. And that money is used first toward your long-term care, bills. If you never use it, you get your $100,000 back.
And so your question is, what do we think? I mean, this is an asset-based,
what do you think about that?
asset-based long-term care. Let me just finish.
It's an annuity.
Yeah. So here's why if you just took that same money and you bought the FSTVX and you bought whatever the other fund was, now I can't remember the ticker. If you just bought a globally diversified portfolio and you got it at like 0.01, just on the money, you're going to end up with more money. And then you just went and bought long-term care, wrote a check, because if you really want to have long-term care, financially, you probably end up better just doing it the way I just described. Probably.
Oh, okay.
Because we've run these numbers before, if I'm understanding the product correctly.
It's very similar to one we've looked at from some other people, Tom, and you know who I'm talking about.
Yeah, it's not that exact, but it's enough similar. So because if you just pull the two apart, but there's generally, when you do the asset-based, you can get into the program if your health is not as good as when you buy a different type of long-term care policy. So not knowing anything about your health, there's a reason to consider it.
And remember, with all of these kinds of products, there are so many caveats and qualifiers built in and extra fees and expenses that they never end up being as good as the sales pitch, or often even close to it.
Tom and Don are talking real money.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
Reality radio for a really great future. We're talking real money.
I spend my breaks researching for you. I do that for all of you listening.
Such a slave to help us. Thank you.
I am. I looked up this ForCare.
Yeah. No, Forethought, I thought she said.
Forethought is the insurance company.
Okay.
ForCare is the
That's with an E?
annuity.
Oh, okay.
Yeah.
Yeah.
ForCare.
And For Sure is what you get?
Yeah. Well, no.
Oh.
Here's the deal. If I put $100,000 in, it's a single premium kind of product.
Yeah.
It's not it's not
Money's in
insurance.
there.
It's a
Yep.
single premium annuity. I put that in. Depending on my health, I get between $200,000 and $300,000 worth of long-term care benefit.
Not cash.
Not money.
Yeah. This
exactly.
Is, right. Money that
They're
could be
saying
used.
that if I then go into a nursing home,
Yep.
I would have $200,000 or $300,000 worth of coverage.
Mm-hmm.
If not, but buy money. There you go.
If not what?
Buy money.
Buy money. Oh,
Goodbye.
buy money.
Bye-bye.
Buy
money.
Buy some money. Yeah, I don't. This is what I don't like
there's
gimmicks.
A death benefit.
I just, and people always ask, "What about?" And here's my take. I have a lot of insurance, as you know. I have a lot of.
You're overinsured.
I know. I have a lot of responsibilities. If I drop dead, there's people that will. They probably won't miss me, but they'll miss the money. So I have a lot.
Isn't that always the case, though? Really, when it comes right down to it.
I have a lot. So, but I don't mish it all up with this. I don't. I want things unwound. I want clarity, transparency, and low cost. I'd love to know what the cost of all that is.
Here's the game they play.
Yeah.
Here's the game they play. They tell you that, at 60, if you put $100,000 in and you earn 5% a year.
That's easy. No
then
problem.
it's going to be 82 before you have $300,000.
So you got to wait a little while.
But the reality is, it's only if you earn $300,000 between now and 80, or if you grow that money to $300,000, that's your money.
So basically, so that's a double would be $200,000. I mean, that's not that long to get a double.
The other thing is that once you get this annuity, if you don't go into a nursing home,
gone.
Buy money.
Yeah, I would just, if it was my money, I'd just go buy long-term care if it's something you want to have. I know you don't have it.
If it's
I know you
something
don't
you
have
wanna
it.
have.
Right. You're going to live in my basement. There's a lot of people who have done that.
There's so much room there.
There's
They've
a lot
lived
of
and
room.
died there.
Yeah.
They've lived and died there.
They have. And now I have a big
Entire
screen
generations
TV
have
right
lived and
there.
passed.
You can be right
and
there.
Now that you got the theater, that's where I want to live.
I know. And I watch Billions every week. Well, Black Sails is over, but yeah, it's comfy. There's a nice little heater. There's a nice little heater there because you won't like how cold it is here all the time. Well, and we talked about this last week because there's another financial guy on the air.
There are 13
he's
others
on
in
500
Seattle.
stations. I didn't know how big he was. We were talking about Dave Ramsey
you're
last
talking about
week.
Dave Ramsey.
Yeah, I mean, I didn't realize it was his network was that big. And we like his get out of debt program generally.
We do.
I do. I like it. I like the fact that he emphasizes that he works hard on it. I think that's perfect. It's when you start getting into the, okay, now I'm saving money, where does it go? Because where it goes
You'll
is
get 12% going to one of my endorsed local
Lord.
providers
Nope,
who's
can't
a
call him that
commissioned
anymore.
stockbroker. I know. The name had to go.
Smart
I love
investor.
this. I knew this was going to happen.
Well, and so interestingly enough, we touched on this on the program last week, and wouldn't you just know it, somebody in the industry wrote a long article this week talking about Dave's program where he hands you off to the local people. In other words, you call in and say,
local stockbroker.
yeah, if you call him and say, I need help, and we talked about this, we'll talk more, that those people are paying for that privilege, but what might interest you is how that's changed recently and why.
I can't wait to share this story. I cannot wait. I always thought that what Dave was doing wasn't on the up and up. 877-397-5666 is our phone number. By the way, it wasn't on the up and up. You'll find out right after this.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
Coming up a little later in the program, we're going to talk about why Vanguard has gotten so blasted big, $4.2 trillion under management.
Index funds?
And why indexing? Why has indexing
Because
gotten so big? We're going to talk about that.
Index is even one over 15 years. We'll give you the headline. Even.
Oh, you gave him the 15? Yeah, you gave him the headline.
Drives me nuts.
That makes you mad.
It just grates on me. Anyway,
the story is Dave Ramsey, many years ago. Dave is very popular.
Amazingly.
Very
big,
popular. Because he combines an evangelical message with a debt relief program. But the problem was monetizing the advice. It's, as I can attest, as one who's given financial advice on the radio, getting paid for it is the difficult part. So they came up with a thing called the Endorsed Local Provider Program, where they would send leads. You would call or go online to their
say,
ELP.
Dave, I want some help. Yep.
I want some help in my area. And by the way, if to be an endorsed local provider, you had to be a full commissioned stockbroker. You couldn't be a fee-only advisor. They would not allow fee-only advisors into the program.
Not those 11,000 people that might give you fiduciary advice. That would be crazy.
No, these are stockbrokers.
Of course.
And the stockbrokers paid an amount of money for each lead they received.
Yep.
And some courts, or no, some
great
departments
state of Missouri
said,
hey, you can't really, Dave Ramsey really can't take that money unless he's registered at the end of the day.
Investment advisor.
Right, you can't give it. He's giving advice. Anyway, it does not work from a regulatory standpoint.
So Dave Ramsey settled, Lampo Group, his group, they settled with Missouri and put $50,000 into an investor education fund and agreed to change the program, which they did. They changed it from ELP to a program called SmartVestor, which I still think, Tom, after reading, I think they're still going to get in trouble with the SEC when all is said and done. Because the SmartVestor program, even though it says it is a fixed fee per month, it's to participate, you pay between $400 and $900 a month to be a SmartVestor.
This is the local broker pays that to Dave
pays that to Dave Ramsey to be on his website.
Yep, that's
Only on his website.
That's right, not on the show.
They don't send you leads unless, the lead comes directly from the website.
Yep.
But your rate changes based on how many leads you end up getting.
Whoa. Your rate change. I didn't know that part. That's right back to where we started.
Exactly.
You can't do that. No, can't do that.
They raise your rate depending on the number of leads you get.
What?
Which some lawyers are saying is not following the letter of the ruling.
No, I think they're going to be in trouble there again.
I think they're going to get in trouble again. So Dave's, and by the way, I've said this so many times, I've gotten slammed. Dave Ramsey is great for debt advice. He is horrid when it comes to investing advice.
He's gone
terrible,
and he's gotten
not
into
just
it.
Bad, about as bad as anybody's advice could possibly be, other than the fact that he tells you to invest. Okay, that part's good.
Get out of debt, save, and invest. That's good.
Right.
It's how you do what you do with the money that the problem
Welcome
is.
to those devilish details. Paul, you're up next. Welcome to Talking Real Money.
Hey, Paul.
Hey, guys. Really like your show. Appreciate it. First time to call in. And I had a comment and a question for you in terms of generating income. Last week I picked up on your MLM discussion, and I would just say, and I'm an expert in this subject. I spent a lot of time in this. And I would just say, please don't include Amway in with all the other MLMs, because the value you get out of the Amway program, and in addition, the margins you're able to achieve for your investment of your time as well as your money is far greater. It's a far greater. So investigate it before you lump it in with other MLMs. Okay, so that was my comment. My question is, what aspect or what approach would you guys suggest in terms of generating income as a person who would be have a full-time job and then do something else on the side? What would you suggest?
Wow, it's like a business development question. What should you do stuff envelopes at home or cook pizza part-time?
Is that what you're asking?
I mean,
what's your ideas?
Wow.
Well, I get a job.
No, he says in addition to having a job.
Get another job.
Well, no, I don't. I mean, if you're asking for, this is not the part. We both have other companies that generate.
You're trying to generate a company yourself.
Yeah, we've done that.
No. But you see, the deal about starting a company, you can't. I got to tell you, everybody in the country is not cut out for starting a company. I've started 4 or 5 of them, and some of them have failed, and some of them have been wildly successful.
Exactly.
You have to have the heart of a risk taker to be able to start your own business. Otherwise, you end up working for somebody else. And if you have one job and you want to make some more money, the vast majority of people, instead of starting a business, are going to go out and get another job. They're not going to sell Amway, and I would not suggest they sell Amway. And I got to tell you, I think that even Amway, which is probably the best of the MLMs, is still an MLM where people at the bottom rungs of the operation end up making little or nothing. The average pay per Amway employee is pretty sorry, particularly when you get down to the bottom of those downstream
it's a pyramid.
lines, those down lines.
Say what you like, but it is
It's a pyramid.
Yeah, so I mean,
okay, they have product. I'm not disagreeing. So does Herbalife,
right.
But I think Herbalife it's not a pyramid scheme, but it's a pyramid-like income opportunity where if the primary way you make money in any business is by getting other people below you into the business to generate revenue off on their backs, then to me, that's multi-level marketing. That's not starting your own business, because unless you're in the top 1/1000th of 1%, you're never going to make good money off of any MLM.
You have a great network of friends and family that want to buy laundry soap. I'm just putting it out there.
You're not going to make any money.
Okay, I have no idea. But if you're asking, the question is kind of, what should you do for extra income? I would, if it was my time, I'd take up something that I enjoy, right?
The average income, I just looked it up in Amway's disclosure statements. The average income for an Amway distributor, active, by the way, not those who are no longer active. This is truly those who are still actively out there selling. Mm-hmm. The average income for an Amway distributor is $115 a month.
That's $1,200 a year. So here's another idea.
Just 1/4 of 1%.
Here's another idea. Do you know how much I make refereeing soccer games annually? I can tell you because I
bet it's more than $115 a month.
How much do you think it is?
I don't know, $500 a month.
No, not that. That would be $6,000, right? It's about half that. It's about $2,600 a year.
A year?
Yeah.
So you make more doing that than Amway.
And I don't have to sell anything other than bad calls. No, I'm sorry. That was too easy. No, I don't know. I mean, but it's something I like doing. That's what I'm saying. Find something you like doing and see if you can turn it into an income. That would be what I do. I wouldn't.
I just got that was an older Amway disclosure.
Okay.
Here's the new one. The new one's $183.
No, so that's
$183.
That's a couple grand a year. Then go ahead.
But again,
that's
the
average,
active.
And that's probably somebody who's been in the program.
And remember,
5, 6, 7 years.
When you've got people in the program making 6 figures,
and you've
got people. You've got people at the bottom of the food chain making $10 a month. I can't get excited about a business like that. That's why I don't
you didn't like
MLM.
the stuffing envelopes at home either, I guess.
I don't care whose brand of MLM it is. I despise MLM.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
Hello again, and welcome to the most valuable show on the radio. It's called Talking Real Money because what we do is talk about the reality of money, not what you like it to be, but what it really is. This is how you really should be investing it, not how you. I mean, if you got your way, you'd get 90% returns, and you could never lose a penny. But that's not real. We talk only about the real,
and
we want to really help you.
If you don't spell check, somebody told me this today that they had it typed in for an introduction of me at this conference I went to today. It could be cooing real monkeys.
Wow, somebody is a really bad typist.
That sounded like something I would come up with.
If they got cooing real monkeys out of talking real
Which kind of hurt my feelings, because I think the implication was you and I were the, primates. Just saying.
Yeah, just saying. Wow, I just looked this up, and it says suggested website, Talking Real Money and App Store, and it says it's in, what language is this in? It's in Portuguese. I'm serious. This is hysterical. Abre atunes para comprar y... I don't think that's Spanish.
Nope.
I think it's Portuguese.
Yeah, well, we're huge in Brazil.
Apparently we
that.
are.
Yeah.
877-3975. Why am I in the Portuguese iTunes store? I don't get this.
Headline, Wall Street Journal.
Is this the one you don't like?
Headline, Wall Street Journal. Indexes beat stock pickers even over 15 years. Even emphasis added.
Why was that?
I tell you why it just grates on me.
Qualifier
well,
necessary.
Because you got to understand the perspective here. If you're listening, the Wall Street Journal hates index mutual funds. They make them basically no money. The whole paper is, and more, by the way, the more you read it, is about the really smart hedge fund manager, the active stock picker that's done well, beating the average for a while until they don't. So when they write these articles, they even have. Here I am, even. It should just say stock. It should just say indexes beat stock pickers, because they do over long periods of time. It's not even 15. The point of the article was, their point was, you had an up market, then a down market, then another up market. Even over that time, indexes beat stock pickers. But what they're really saying, if you read between the lines, is can't believe an even over 15 years. That's what they're saying.
Well, because I really believe that even in this day and age, with all of the proof that we have, and it's some seriously good research, that folks at the Wall Street Journal and Money Magazine and Kiplinger's and the like still want to hang on to this belief that there is, because they're among the group of smart people out there, that there are smarter people when it comes to investing, people who are better at picking good stock.
And who's the guy who does
what are they good for?
Exactly. Who's the guy who writes the column but also has the radio show? I forget his name. We've talked to him before. I can't see it. Yeah.
Chuck Jaffe?
Chuck Jaffe. And if you get him on the air, he'll say, yeah, you could kind of you could own indexes, but you can still find those active managers out there who are better. No, you can't. And maybe you do, but they've already been better. Or maybe you did and they're okay for a year or two, and then they regress to the mean and they make, less than index. Just own index fund. Accept it. Take what the market provides. Most of you don't get that because you move money around, or if your money's at Merrill Lynch, it really should be at Morgan Stanley. No, own index funds. And we're going to have to look into this more, but frankly, we've been really talking about Vanguard, as you said, for several decades, but Fidelity's sounds like that's some very inexpensive funds too.
Then,
so
good for them.
Yeah. Well, they're no dummies. they can see.
Fidelity has believed, the Fidelity Group, the family that runs it, they believe that
the Johnsons?
active management, the Johnsons, they believe that active management is superior to indexing, and they've poo-pooed Vanguard for almost as long as Vanguard's been around, Fidelity, by the way, several years ago was the largest mutual fund company in the world.
And their performance at Fidelity has been poo-poo compared to indexes. Just saying.
Yeah. And now Fidelity manages $4.2 trillion.
No, you meant to say Vanguard.
I mean Vanguard.
Yeah,
$4.2 trillion. Now let's put that in perspective. Do you know what the GDP of the United States is?
Isn't it like 3.8 or something?
18 trillion.
18
so
trillion.
It's about 20% of the entire productivity of the United States of America.
You
in
go,
a year.
Vanguard.
Whoa.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
Have you noticed? I didn't even notice this. Have you seen a column from Chuck Jaffe recently at MarketWatch?
I don't frequent that website because it just gives me the what. Uh-oh.
Well, he's no longer writing for MarketWatch as of January. He's no longer writing for anybody.
Oh.
It's a tough biz we're in.
So but he still has the show, right? Doesn't he have like a podcast or something?
Podcast,
okay.
Yeah, Money Life, but that's it.
Wow.
Well, I got to tell you, it is hard to get a paid job in the investing business anymore because there are so many people willing to write and talk and do everything for free.
Or so it appears.
Or actually to pay to do it.
Exactly. Yeah. So
there are 14 shows in the Seattle area, 14 of them on rated radio stations. And of those, it's about 80% indexed annuities.
Apparently, there's big money to be made in that. As I often say,
deplorable.
We're in the right business, just the wrong part of it.
Yeah, for us, for our personal benefit, yes. Okay. RJ, you're next. Welcome to the show.
Hello. I surfed through the internet and I ran across a court case dealing with usury rates. Each state establishes a usury rate that is governing how much, they send Al Capone to prison for exceeding usury. So I look at this case. It's a New York State case that establishes interest rates for bondholders. And the case was 239 corporations were appealing a case that said we want unlimited usury. So they listed the amount of bonds, the amount of education loans, the amount of home loans, the amount of car loans, and I believe it came to $300 trillion. And then they said we want unlimited usury. So if you call a call center and you adjust your payment schedule because you lost your job or something, they will go ahead and do it. And their petition to the court was, then we would be allowed to charge unlimited usury.
Okay,
is there a question here?
But what I'm wondering, RJ, is where are we going? Where are we going with all this? What are you asking us?
Well, the bond was a country of Argentina.
No. I don't want any more information on the specifics. What I'm looking for is the point. You could just continue to go on and on about all the specifics of the case. What's the bottom line? Give me the quick down and dirty version of this whole story.
You're talking market share, world economy. U.S. has 1/3, Asia has 1/3, and European Union has 1/3.
Pretty much so far, your numbers are all off. The U.S. is almost exactly 50%.
Well, now that's market cap of stocks.
Right.
Not,
okay. If you're talking about a
GDP,
GDP,
he's about right there. Yeah.
But what's the bottom line?
What would you like?
Still, what's the point you're trying to make?
The bottom line is who controls the world economy. Their premise was 239 corporations.
All right. That's great.
Just 239 corporations, and I bet they all have black helicopters.
Now I'm going to have somebody escort me to my car or something.
It's the Trilateral Commission, darn it.
Yeah, isn't
it's
it the
that Trilateral Commission.
Skull and Bones Society or something?
No, I think they're members of the Trilateral Commission, and it all comes down to them. Yeah. It's the boys in Brazil or whatever that thing. I don't know. It's
cabal somewhere that's running it.
Yeah. Do you know how hard it would be for one little tiny group to run?
I think they're meeting in my basement tonight about 7 o'clock with candles. Sorry. No, I mean, really, come on. You imagine where the world economy is today, and go back 20 years. Go just even 20 years and look how different. This is pretty easy to do, by the way. You can look at the value of companies in the United States versus the value of companies in other places, just as one thing. Because 20 years ago, I think you can correct me if I'm wrong, but I think I'm pretty close. It was about 75% of the value of firms was in the United States, and about 25% was outside. Today, it's about 50-50. Now, if there is a group of people that are controlling all of those companies, all of that wealth, and has some master scheme in mind, some huge conspiracy that is being worked up, wow, good for them, is my take.
Well, and here's the other thing is I was still trying to get the usury thing. There's this little crazy thing called the internet, and I was looking for a court case about bonds and usury. First, I couldn't even figure out how bonds and usury went together. I don't know. Because usury is about if I was a creditor, I couldn't charge you more than X amount based on whatever.
And I don't think that even applies anymore because I believe, what about payday loans? I mean, they have it's like if you get a payday loan and then you get another one, you're paying like 300% a year in interest. It's some ridiculous number. I don't think there's any limit to that.
There was a case, and it was recent in the New York Supreme Court, which I believe they tried to make a loan usurious under New York law, a payday loan, and they lost.
Yeah, I don't know. Remember we don't want to go down the payday loan thing because remember last time we did that on TV, and I compared the payday loan guy to the the
coke
drug
dealers or something,
crack dealer. My own mother got mad at me for that one, so we don't want to go. She thought it was cheap. She thought it was a cheap shot.
Payday lenders get these poor people addicted to their product because you are paying so much in interest that the only place you can go to get out of the hole is back to them, and you pay them 300% for the rest of your life or until some guy from Bruno's Payday Loan Emporium comes over and breaks your legs.
And but it wasn't my quote. I had a quote from a consumer affairs person that said, I'm not even going to go there. It was exactly what you just said.
We were actually supposed to be
people
talking about
don't complain
index
about
funds.
their crack dealers. So I used that line, and he got very upset. Oh, Mom didn't think it was fair. Anyway, we were talking about index funds before we went. I don't know that.
Before we went off.
I don't know.
On the usury
RJ veered us off on the wrong course there. It's not my fault.
All right, well, good. I can hear the music. That
was not a planted call either, by the way.
That means it's time for us to take a break. I'm going to head down the way, and I got to get my aluminum foil and start building the hat.
There you go.
I'm building my aluminum foil hat next. And then before we talk about index funds, I don't want anybody invading my brain with something that might make me think active management works. Because it
Tom
doesn't.
and Don are talking real money.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
For your real life and real future, Tom and Don are talking real money.
I thought the full moon was last week, by the way. I may have had it wrong, but I think it wasn't this week. It was last week. Wow.
Isn't Donald Trump chairman of the Trilateral Commission or something?
That's Skull and Bones. You get the two mixed up.
I get it mixed
It's
up
Bush
all the
running
time.
Skull and Bones. So, yeah.
So the Wall Street Journal just came to the realization recently that index funds beat actively managed funds.
Well, it wasn't their study. They just reported on it.
For 15 years even.
You're going to just keep poking me in the eye with the even. It was not their study. They merely reported on a new study. There are legion other studies. There is so much research that we could spend hours upon hours just reading this stuff, saying that there is no genius, there is no guru, there's no charlatan. Yes.
There's a really smart man at Stanford University by the name of William Sharp.
Yeah.
He won a Nobel Prize for really complicated, scientifically based financial stuff.
He's got a ratio, I think.
But his paper years ago, I think it was in 94, he wrote this one-page paper. It was really short. Maybe it was more than one page. And it was called The Arithmetic of Active Management. And he proved with a simple, tiny little formula that it is mathematically impossible for actively managed mutual funds to beat the market in aggregate after expenses.
That doesn't matter because that's the funds you're going to own. The ones I'm going to own are going to do far better. I'm above average in everything else. I'm above average working out. I'm above average driver. I'm above average lover. All those, I'm going to make more than you. That's just the way it goes.
And that's the problem with our portfolios, folks. The problem is we believe we're smarter and that we're going to be, we hear it from people all the time. I have a great portfolio of stocks. I did some really great research. These are wonderful companies. Why would I want to get rid of these great companies that I spent so much time researching? Because, folks, every stock you buy, I don't care how good your research is, you need to remember this fact. Every single stock you buy, you are buying from somebody who thinks it's not good.
And 90% of the people that are doing that, 90% are institutions. Do you think you, the investor, has more knowledge than the person on the other side of the trade or less knowledge about that company? I'm going to just go out on a limb and say they do because they spent, I talked about this at the class today, they spend a lot of money researching stocks, including satellite pictures, which I guess you can probably get relatively soon from what I understand. Satellite pictures of things like Walmart shopping or parking lots to see how the activity is.
Problem is, you can go on the web and get satellite pictures of almost anything, but if you want really up-to-date satellite pictures, they're going to cost you far more money than you're going to have available to invest, and they have it.
There's only one guy I know that has been able to do this for a long period of time.
Donald Trump.
Nope.
Because he controls the satellites now.
Bobby Axelrod.
Bobby Axelrod.
He's the only one I know. By the way, my Axe Capital vest is coming. I'm gonna have it soon. I hope summer doesn't arrive soon.
For those of you who don't know what the heck Tom is talking about.
Oh, it's going to be great.
There is no real Bobby Axelrod. He is a fictional character on a show called Billions.
Which
that
I
is,
recommend.
I think, loosely based on the life of Stephen Cohen.
I thought we decided it was somebody else.
I still think it sounds like Cohen because the U.S. attorney, Cohen wrote a big check. And,
yeah, that's true.
Anyway,
Anyway, if you want to read about somebody that is a successful, active manager of money, I mean, watch a program, that's the program to watch.
Okay.
Because he cheats.
Right.
Yeah.
I was going to say,
There's that part of it.
If you're looking for a role model in the active
no.
management arena, a real one, if you want to find a really successful long-term active manager whose success is not attributable more likely to luck than skill, best of luck.
Good luck.
I don't believe, if they exist, there are so few of them, you're not going to know who they are. 877-397-5666. You want a little help getting this right? Give us a call right now.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's full color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
Reality radio for a really great future. We're talking real money.
It makes me long for the days when I did my show back at the beginning with Business Radio Network when I was on
Ways
around
and
the
Means
country.
Committee.
I was on Saturdays was a normal time, like this time.
That's right.
Actually,
Yeah, it was
every
Saturday afternoon.
It was noon.
Right.
Yeah.
Mm-hmm. Well,
but at my weekday show was on.
It was like 6 to 10 or 7 to 11.
No,
or
it was
something?
midnight. Originally, it was midnight Eastern to 5 a Eastern.
So you get you pulling some out of the woodwork.
God.
I think my favorite for those when you had the guy who fell asleep and you could hear the crickets and you kept going back to him. You could hear the crickets.
He had the best phone line, I think,
It was clean, man. That was clean.
He called apparently from his porch late at night. And
great show,
apparently he was like on a settee or in a hammock on the porch, and he got so comfortable on hold that I went to the call, and I remember distinctly, we went to the call. I was doing the show out of Walt Disney World, and I went to the call, and I go, "Welcome to the show," and you hear this.
Great show, Don. Very stimulating.
Oh, and my producer had a field day with that.
Kept going back to it. It was good.
You put the audience to sleep. And I said, now do me a favor. I just want to make sure he's okay. Turn the volume up a little bit. And so he turned it up, and you get... and in the background, you can hear that chirp, 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 chirp of the crickets.
Yeah, you could.
And so we kept the guy on hold because we felt obligated
Make
to
sure
check
he's
on
okay.
him.
Yeah.
He's on his porch at night. Who
That's
knows
true.
what the neighborhood's like?
That's true. Yeah.
We wanted to make sure he didn't die during the course of the program because we felt some
Because the
responsibility
program
for
already
it.
had, apparently.
Plus, knocked the guy right out. So wait, I have a great idea.
You're like,
I didn't
RJ,
realize,
get to the point.
I didn't realize that this was a multi-purpose show. You can go to talkingrealmoney.com anytime and listen listen to the podcast of our program.
That's true. That was the point of that entire story?
I'm almost there.
Okay. I only have 90 seconds.
You can tell you're a short timer. You just want to get the heck out of here.
Donka Shane, darling.
If you're having a little trouble getting to sleep at night.
Hadn't thought of that.
Go. Okay, Google, play Talking Real Money.
Yeah, and that works too, by the way.
It does. They haven't shut us off.
No,
they shut Burger King off, but they haven't shut us off.
Well, different reasons. Yeah.
So anyway, Tom, lovely seeing you again. 877-397-5666 is our phone number. 877-397-5666. He's going to hit the road, and we're going to talk a little bit more about how you build the future you deserve and need, and, some of the basics of investing. Oh, as a matter of fact, before we go to the break, I wanted to, recently I did, and I'm rambling a bit, but a lot of folks have told us, well, yeah, okay, I get that. What's an equity? I get that we should be investing, but what's an equity? I don't understand what an equity is. What is stock? So I decided to start doing some features on the basics of investing. So recently I did a series of 5 one-minute features on stocks and what stocks are and what the difference is between common stock and preferred stock and how you can invest better in stock. And these were on the radio, but I also put these, because they're so valuable, online at TalkingRealMoney.com. So go to TalkingRealMoney.com and click on the feature tab, and you'll find those there, along with a lot of other good stuff. If you're looking for, during the course of the week, if you're looking for some investment help, or you're telling your friends, I listen to these guys on the weekend, and I don't remember who they are, just remember TalkingRealMoney.com and go there for podcasts, for videos, for some of the features, some of the better features, to sign up for classes and events, to take a risk survey, we have a retirement calculator. I just realized we have an awful lot of stuff there. So go visit TalkingRealMoney.com and then give me a call, and let's get your life on track to a really great future. 877-397-5666, 877-397-5666.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address. So go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, right now it's just Don. Tom snuck out. Wanted to get an early start on the rest of his weekend, but he deserved it. He worked hard today. So I'm here with you at 877-397-5666, 877-397-5666. And remember, you may hear this show as a podcast or elsewhere at a different time, but you need to know that you can call between the hours of noon and 2 Pacific, that's 3 and 5 Eastern, only on Saturdays at 877-397-5666. You can also follow me on Twitter and tweet me questions, and it's really easy. My handle is @DonMcDonald. In fact, we got a couple questions last week. Oh, and I did get an email question from somebody that I think is worth mentioning to all of you. A woman wanted to sign up for one of the upcoming classes in May. We got a bunch of classes coming up, and she was wondering what if her schedule precludes her from coming. Well, we're not gonna keep your money. If you can't make it, let us know. We'll refund your money. We're not charging you to make money. Trust me, we pay more for the rooms than you pay us. There's a really good reason why we charge. It is to, well, one, it does recover some of the costs because we don't want to put those on the backs of our clients. But also, unless you pay for something, you don't assign any value to it mentally. People didn't show up when they didn't pay. Plus, it does allow us to do better handouts. Our handouts have improved dramatically. It's like getting a book, and so you get a lot more out of it for your $5 or $10. It's going to go up to $10 after tomorrow. So So give me a call, 877-397-5666, 877-397-5666. And as I mentioned earlier at the beginning of the show, $800 billion over the past 3 years has poured into Vanguard's mutual funds, while the entire rest of the industry has taken in about $97 million. The reason for that is the simple fact that people are starting to get it. You as investors are beginning to understand that that just because you pay someone a commission up front and higher annual fees doesn't mean you're going to make more money. As a matter of fact, it improves your chances of making less money. The math is very simple. If you go through your broker at Ed Jones or Ameriprise or Merrill Lynch or Morgan Stanley or wherever, LPL, most of the time they are going to charge you a commission to go into a mutual fund. And to justify that, of course, they're going to try to put you into a fund that appears or promises or implies some kind of edge, and indexes don't promise or imply any edge. An index fund says, I'm going to give you what the market makes. So why would you pay somebody 5.75% up front to get what the market makes? No, they have to have a pitch that makes it sound like the market's going to make you more, or their product's going to make you more than the market. So think about that. You pay 5.75% up front to get into the funds with most brokers, and then actively managed funds, by their very nature, have to have higher fees. Vanguard's or Fidelity's or Schwab's fees on their index products, their diversified index products, well less than 0.2% a year with nothing going in. One of the least expensive actively managed fund groups with 5.75% commissions up front is a company called American Funds. Their actively managed funds, while less expensive than the average for the industry, still come in at 6 or 7 or 0.8%. In other words, 4 or 5 times more in annual fees. There's a simple fact. Assuming even no commission, just do this math. You have two funds. The two funds have identical performance. They both, let's say, return 5% per year, or that's what you expect them to do. The fund with 0.1%, or that's fair, 0.1%, will net you 4.9% per year, while the fund with 0.7% per year will net you 4.3% per year. They have to make, just to break even, they have to make 0.4% extra every year, or, looking at it another way, their performance has to be 10% better on average every year for them to justify their fee. And there is no evidence that consistently anyone can generate that kind of extra money on a year after year basis. Yeah, sometimes over a year they'll win, but more often than not, they won't, or at least they won't do any better than matching the market, which means you as an investor end up with less. Why spend money unless you actually get something for it? When you go to a stockbroker or you go to an insurance agent, generally you get advice in that moment, generally. Of course, there are exceptions. They're few and far between. Generally, you get advice in that moment to make a transaction. You pay a commission for that. You pay higher fees along the way. What are you getting for the money you paid? Are you getting ongoing advice and hand-holding for the rest of your time in that investment vehicle? Most of the time, the answer is no. They're going to go on to the next sale because they're not being compensated on an ongoing basis to take care of you. The mutual fund that charges you more per year, and the average more per year of index funds is more like 0.7, 0.8, 0.9% a year. That extra 8 or 0.9% a year, even 1% per year, is not going to give you a better quality of service or better experience. No, it's not going in there. You're not paying that to get rebalanced. You're not paying that for advice. You're not being paid that to get to know you and understand your needs and wants. No, you're not getting anything for that. You're not. You're getting active management, which has no value. If you're going to pay extra, pay extra for something of value. If you could do it on your own, you do index funds. If you need help investing, then you need to find somebody who will actually follow the science and provide you with an added level of service. And it's interesting. There have been now 3 studies done that have shown pretty consistently that a fee-only advisor helping you manage your money, a fee-only advisor adds somewhere between just under 2% per year and about 4% per year. That was from Vanguard, by the way, who did that calculation, in added value because of the personalized service they provide and the fact that they keep you from behaving badly. And they build portfolios that are actually created for your risk tolerance, so you don't do what most investors do, and that is buy when it feels good and sell when it feels bad. In other words, buy high and sell low. And that will destroy you. And as a matter of fact, it's destroyed investors for decades. Decades. Check it out. Dalbar does a study. Go to Morningstar one of these days and look at the investor return on a fund compared to the actual return to the fund. You'll see that you're your own worst enemy.
Tom and Don are talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?